actually depends very significantly on what is going on in the energy sector. These are some numbers. So I want to get on to the critical role of what the central bank actually does. And in a sense, the bank has two significant mandates. One being financial stability, the other being monetary stability. So we talked about that monetary system. It's very important that these two systems work effectively. And monetary policy is a simple thing. These are just the actions that the central bank will take to create the right conditions for economic growth. So the central bank would use its tools, its interest rate tools, to actually manage monetary conditions in the economy. And there are really three objectives that we work towards. We try to ensure that the rate of inflation is low and stable so that our citizens can afford to buy the goods and services they need to maintain their welfare. We have to ensure as well, because we are a small open economy, that we have a sufficient quantum of foreign exchange reserves available so that we can pay for goods and services. And we try to maintain a very orderly foreign exchange market. These key things are really important to reinforce this monetary system. I will talk about this very, very quickly. Before 1993, we had a fixed exchange rate system. That is, we were pegged in a fixed parity to the US dollar. Since 93, we have opened up the foreign exchange market, and our exchange rate can move. Very importantly, it can move, right? It can go up or it can go down. It can, in economic jargon, it can appreciate or depreciate. And monetary policy has also shifted from a focus on the reserve requirement, I will explain that a little later, to a number of market-based tools. Because we're trying to develop these financial markets, you would hear a lot of terms called open market operations, and you would hear the term repo rate a lot, right? This is where a lot of my life is centered on a daily basis. So statutory reserve requirement. Now, for us to manage the commercial banks, the commercial banking system, and how much money they loan at any point in time, we have a system of reserve requirements, i.e., when commercial banks take deposits from you, we take a certain proportion of that money and we hold it aside for safety. So if they give you $1, we will take 17 cents out of that dollar and we put it aside. And we can manipulate that proportion to tighten or to ease monetary conditions, right? So that particular ratio is what we call the reserve requirement ratio. So if we raise the reserve requirement, for instance, from 17 cents to 30 cents, commercial banks have less money to actually lend to you. And we can control how much money they put out into the system. Similarly, if we want them to put more money into the system via loans, we can lower this reserve requirement. We can say, okay, we'll only hold 7 cents. And out of the dollar, they therefore can lend 93 cents to the market. So the reserve requirement was a critical tool that we used to tighten monetary conditions when we needed to do so, or to actually ease monetary conditions. So by raising it or lowering, we can change how commercial banks actually behave in the market and how much money they make available for loans. We have now shifted somewhat from that. We still use the reserve requirement, but we have introduced what we term open market operations. These are treasury bills and treasury notes. The government, in a sense, gives you an IOU, a bill or note, and the central bank can use these instruments to determine when to put money into the system or when to take money out of the system. So essentially what I do, if I want to tighten monetary conditions, I will come to you and I tell you, look, this is a government bond I have, an IOU, you hold that, and I take a certain amount of money from you, which is kept in the system, and in that way I pull money out of the system. And if I wanted to ease monetary conditions, what I would do is I will come in to the system, take a bill from you and give you money. Right? So by using these open market operations, we can affect how much money enters the system and how much money is taken out of the system. And in 2002, we adopted a new framework actually for monetary policy, which is important. You see these notices in the papers every month. You hear about the repo rate. The central bank is moving the repo rate. What is this repo rate? And this is the notice that you'll see me, I'm directly responsible for every month. Commercial banks, if they want to borrow from the central bank, we charge them a particular rate for borrowing overnight. So if they are short of funds, if they need money, it's like if you need money from your mother or father, they can tell you, well, listen, I would lend you, but I'd lend you at 10% or at 5%. Okay? And this is precisely what we do when we deal with commercial banks. We say, okay, you need to borrow, you're short of money, okay, I will charge you 5% overnight. I will lend you this money, which you have to pay me back the next day. And we use this rate to actually impact how other rates in the system move. So if we wanted to pull money out of the system or tighten the system, we would actually raise the repo rate. And in raising the repo rate, the cost of funding for commercial banks become more expensive. So rather than charging you 3%, I may charge you 7%. It becomes more expensive to borrow, and therefore they will pass on those borrowing costs to the rest of the society. And to ease monetary conditions, we have been lowering the repo rate so that, in fact, it's cheaper for them to borrow. So since we have had the recession in 2009, you would have noticed that the central bank has been lowering this repo rate. And it's to try to encourage, in fact, a greater borrowing in the society and better monetary conditions. So the mechanism works very simple. I have a little diagram. You just have to press continuously. Right. So if we wanted to raise rates to control inflation over time, we would increase the repo rate. So once inflation takes off and becomes too high, the central bank tends to raise the repo rate so that we can actually discourage borrowing. If inflation is relatively low, the economy is not growing as fast as we want, we can lower the repo rate to encourage people to borrow additional sums of money. And the decisions on these are therefore taken by particular committees, the Monetary Policy Committee, which is chaired by the governor, and another committee which I chair, which is called the Policy Support Committee, which prepares all the recommendations. And very quickly now to talk a little bit about financial stability. Within the last 2 years, this has become particularly important given the crisis that exists in the global financial system. And also we have had our own financial difficulties here with the crisis at CLICO, as you are aware of. But the basic objective of financial stability are, we can look at 4 key things that we need to do. We try to maintain confidence in the financial system. If people are not confident about the financial system, they would not invest in the system, they would not deal with the banks at all, and we would have a problem. So maintaining confidence in the system is a key part of financial stability. The second thing we try to do is to promote efficient banking and fair banking practices, etc. Very important for financial stability. We don't want our banks being inefficient, because at the end of the day, if they are inefficient, the customer will pay for this via sometimes very high spreads. So it's quite important that we promote efficiency and fair banking. We also have to ensure that we protect depositors, policyholders, and pension plans. After all, if you're putting money into the commercial banking system, a key role of the central bank is to ensure that that money is safe. The money that you put into the commercial banking system is safe. And therefore, what we do is that banks have to deposit reserve requirements with us. They have a number of things they have to do so that we can ensure that your money is safe. And therefore, we supervise banks to